Good morning, Thursday, December 4th, 11:20 a.m. Eastern Standard Time, so late morning. This is the 10th episode of the WTK report. I haven't recorded one since November 24th. Can't remember if that was a Monday or Tuesday, but it's been about 10 days. So it's amazing how time goes by. I mean, a lot has happened in the markets. And under the surface, and at the same time, volatility at the top of the market really is pretty benign right now if you just look at the daily price movement. So I wanted to talk about a couple things today. One, you're starting to see a rotation into value again, and so I wanted to frame that with what's happening this year versus some of the past context. So this year, the Russell 2000 Value Index is up 13.5%. It's been stronger as of late. It's outperforming this week. For example, the Qs are up 22%. So in my writing, I frequently use a chart comparing the ratio of the QQQ to the IWN, which is the Russell 2000 Value Index. And we are pushing levels that are very similar to 2000. So I'm expecting a sustained rotation into value stocks. And, um, I was, to be fair, I've been expecting this for a while. We did get some of that rotation starting in 2021, and then we're back. That ratio has risen again to these extreme levels. So I'm encouraged by price action here, the last couple months. Really, kind of quietly, the the tariff low in April, when you look back at it, it's very reminiscent to the pandemic low in 2020. Because there was indiscriminate selling. The growth stuff was the first stuff that bounced back, but beneath that, you then got a rotation, in 2020 into energy and value and cyclical stuff, and that seems to be happening once again. Now, looking back, uh, you know, if you go back to 99, 2000, that's when the telecom and tech bubble peaked. At that point, that ratio of large cap tech stocks to small cap value stocks was at this extreme. Then you had basically 7 years or maybe even 8 years of relative outperformance all the way into the 2008 market decline. So, if you could have just gone long value versus growth in 2000 and held that, for a secular bull market in that relative ratio, you would have done very well. And, you know, uh, then when we had, I mean, we forget now, but the decline in '08 into '09, the S&P was down 60% from its top to its bottom. So it was a much bigger decline than we saw in 2000 to 2002, where the S&P declined 42% from the top to the bottom, and it happened in a compressed time frame. And then, the accounting standards were eased, and then obviously interest rates were cut, and monetary policy was aggressively eased in in the spring of 2009, and that spurred this secular bull market that we've been in. The first peak was in 2021. The echo peak was in looks like now maybe October of 2025. It's to be determined because we're still we're not very far off the peak here in the October high in the market. But we'll see where the next couple months take us. So looking back again historically, you wanted to be long value and particularly small value from, call it, 2000 to 2008. In that 2008 decline, it and I didn't even pick this up because I was still, I've had a value bent, even though I try to be open to growth investments. So in '08, '09, I was looking for these opportunities in downtrodden things, and but the real opportunity was in, if you could have separated yourself from that chaos, because it was a chaotic environment. You had AAA rated companies, AIG, Fannie Mae, that were being eviscerated, and these banks that were around for a long time. They were getting consolidated at bargain basement prices. So what people thought were pillars, especially of the financial complex, of the value complex, that value was questioned very aggressively. But in the midst of that chaos, growth really held up better on a relative basis. And it made sense if you look at the historical pattern, because you had value and small value really outperformed from, again, 2000 into 2008 at the peak. Then through that 2008 to 2009 decline, on a relative basis, even with the S&P down 60%, the growth, and particularly large cap growth, held up better. So that was kind of the signal or the tell. And then large cap growth has largely led the secular bull market from 2009 into 2000, 21 peak and now the 25 peak. Again, though, quietly, and energy is such a small part of the S&P 500 now, as small as it was in 2020, but quietly, energy and many value and cyclicals have outperformed since that 2020 bottom, to the secondary echo peak or echo bubble peak in the market in 2025. There's been a lot of volatility, though, so it's not apparent. Not only did you have that pandemic, V-shaped decline and bounce, and then you had the market corrected, the S&P 500 corrected by over 20% into the 2022 low. Famously, then OpenAI came out with ChatGPT in November of 2022, and then NVIDIA in the spring, in their May 2023 earnings results said we're going to be on this new investment wave, which is proven, that was an understatement. They were accurate. It sparked this echo bubble, peak now in the broader market indices. And once again, you're at the point where value, is, comparable to where it was in 2021 or comparable to where it was in 2000 in terms of the relative ratios. And then quietly, you're starting to see outperformance again. So touch wood, knock on wood. But I wanted to characterize that, and you'll see in my writing here, I'm going to use that chart again, that QQQ to IWN relative ratio. And, we're set to really outperform from a value perspective, because the extremes are, we could always go beyond where we were in 2000. I never thought we'd get back here, but we have. However, it does seem to be, there's cracks under the surface with the large cap growth, some of the drivers there. And I always say the narrative follows price. So far we've held near the highs, but if the market turns down, the narrative will start to change. And the opportunity today, the relative opportunity, is there's so much more passive money in the market. So this is price insensitive and valuation sensitive money. It goes into the biggest stocks, through these fund flows, and the degree of separation between the biggest stocks today and where they were even in 2020, 2021, they're orders of magnitude bigger. And this is ultimately going to create significant opportunity if you can avoid being in those largest stocks when you get to the reversion to the mean. And I think that's on the horizon. So just trying to get back into I had a streak where I did 9 of these in a row. I'm going to try to start another streak here. Obviously busy around the holidays with family and just stuff going on. I've had some meetings. I'm going to post this. It's 11:29. I'm going to try to get a workout in, and then I've got a lunch meeting. So I'm going to try to post this later this evening after I do my kid pickup from school. And, then I'll try. I want to do one on walking for Fitness Friday, but I also want to recap some of the market price action because it's been interesting and encouraging. And there's a lot of, I've teased, I'm doing my free cash flow list. I've been looking at Neighbors and BR, which I go back a long way on. That's one that Marty Whitman, basically of Third Avenue Fund Family, um, his cornerstone investment was kind of a big leverage bet in Neighbors, and he turned basically that one bet into the Third Avenue family of funds, and that was during the era where value managers like Marty were revered, and that era has come and gone. But you can make an argument that the normalized free cash flow yield for Neighbors here is 35% and above. And I was looking at it. It's risen a lot this week. The energy complex has risen a lot. The oil services companies have risen. Offshore has risen. Then our natural gas equities, our targeted ones that we've been largely in since 2020, in a big way, have risen pretty aggressively. But Neighbors had a big day yesterday. I was looking back to its highs. 5 years ago, we're about 4 times where it is now. So even though it's rebounded pretty aggressively from the April lows, that's an interesting stock. So, there's debt there, but we've always had success, not always. One of the areas of opportunity that we've had is in identifying undervalued investments, and then the enterprise value is transferred from debt to equity as that free cash flow, kicks in and debt is paid down. Neighbors has that opportunity in front of it, and it's pretty small cap at this point. The market capitalization is not big at all. So keep an eye out for more on Neighbors and more on free cash flow and more on my E&P update. I'm rocking the Pacers, blue and gold. This is a playoff shirt from last year. They lost to the Nuggets, got crushed last night. But you gotta, you stick as a true fan, you stick through the good times and the hard times. Definitely hard times here. It gets me to another one of my sayings. Conviction must be earned, not borrowed, and that's true for sports teams as you're a fan, or it's true for stocks. If you're in a stock and you're doing the analysis, you come to the conclusion that's undervalued. You're doing that work. It doesn't always turn in the time frame that you want it to turn. You have to keep doing the analysis, keep building your conviction, and when you earn it that way, you can then handle some of that volatility, which is inevitable. And if you borrow conviction, so if you just get an idea from somebody else, that first sign where there's a test of the thesis, you're not going to be able to stick through that. So just keep that in mind. Narrative follows price. Conviction must be earned, not borrowed. Keep doing the work, and we should have a excellent backdrop here as active stock pickers. And it's really been there since 2020. It's just hidden in plain sight. But the opportunities, on an absolute basis, because there's a lot of stocks that are 10%, 15% plus free cash flow yielding companies here, where the market, the big cap, large cap tech stocks are in the 1%, 2%, 3% range, maybe even negative in the case of Meta or Amazon right now. And then on a relative basis, it's you could see both, that alligator jaw kind of close where some of the high value stuff comes in and undervalued stuff comes up. So it reminds me a lot of 2000, and it should be an awesome time to be an active stock picker. So happy Thursday. I'll try to do another one of these on Friday. I'm going to post this Friday or Thursday evening, and then we'll see when I do mine on Friday. Have a nice day. Great weekend. Talk to you guys later. Bye.